1982. So this is another one, cover story, banking takes a beating. So we're having a financial crisis these days, right? So what happened the last time we did this? Banking takes a beating, details the falling out from deregulation of banks, an increasingly competitive landscape. This was, look at the bank, awash in troubles, December 3rd, 1984. What was Time magazine saying December 3rd, 1984? Bankers now face their most strenuous survival test since the Great Depression. Because of poor management, overzealous lending, I've heard that recently, and bad luck, commercial bank profits have been battered. So history is repeating itself a little bit. The clearest example of industry's chaos is the growing string of financial failures. Government regulators have put more than 800 of the 15,000 banks on their problem list. American consumers are increasingly concerned about the safety of their money in the bank. Have you heard that recently? Heard that recently. Despite all the bad news and the reports of high borrowing rates choking consumers and businesses, as well as bank failures of the early 1980s, the U.S. economy and stock markets continued to prosper. The S&P climbed nearly 325% from January 1980 through September 1987. So did the headlines give you a clue that that was going to happen in the stock market? No. It's a real disconnect there, too. Here's a good one, something you've probably heard recently. The U.S. could not go on forever spending more than it could tax itself to pay. Buying more overseas than it can earn from foreign sales, borrowing more abroad than it can easily repay. There had to be a day of reckoning, and it could unhinge the whole world economy. On all the world's exchanges, prices have leaped too far, too fast to be sustained. The next slide's going to give this away, but here we go. Then trading began in New York, and the unimaginable happened. A collapse on the scale never seen before. No, not even in 1929. Prices went down, 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 swiftly wiping out the entire year's spectacular gains. Black Monday, the Dow plunged 508 points, 22.6%. Anybody remember this? No? Before that. October 19th, 1987. A wild week on Wall Street. The world is different. You heard that recently? 1987, the world was different. So what happened at that point? These were the headlines. What was going on in the market? The market recovered almost half its losses on Black Monday within the year. Finished the year with a positive 2.3%. Not exciting, but surely a whole lot better than last year. The S&P grew fourfold during the 80s, generating an annualized return of 17%. So again, pretty big disconnect between the headlines and what happened in the marketplace. Here's a good one. This guy's clinging to the clock. Looks like he's about to fall quite a bit. It's called high anxiety. This is 1990. Looming recession, government paralysis, and the threat of war are giving Americans a case of the jitters. So what was inside? War rumors have whipsawed the world's stock markets, heightening the mood of impending economic disaster. Now, when was this? 1990, Gulf War. Among U.S. companies and consumers, the weakening economy has contributed to a national sense of uncertainty and malaise. Might have heard something like that recently? But stay tuned. The U.S. dipped into a recession for a short time, and the markets posted a modest decline in 1990. But by the mid-90s, the economy was going strong, and the S&P generated an annualized return of 28.6% from January 1995 through the end of the decade. Kind of see a disconnect between the news headlines and the returns? Here's a good one. I'm sure you remember this time. September 1998. The question on the front of Time magazine is the boom over? Do you remember what the boom was? It was the tech boom. Was the boom over in 1998? No. Seemed like it would be. Prices seemed kind of crazy, but the boom was still there. What happened? The question inside of Time magazine, the question was, should they pull all of their money out of stocks? Do the markets foretell a recession? Well, the boom wasn't over, at least not yet. The S&P returned 28% in 1998, and 21% in 1999. So if you'd listened to the headline or you'd taken the question pretty seriously, you would have missed some pretty awesome returns. Through the 90s, the S&P generated an annualized return of 18.2%. Here's another one. March 26, 2001. You remember what was happening in March 26, 2001? It was a tech bust. We had the tech boom, now we're going to have the tech bust. And this looking beyond the bear. Yes, it's scary out there, but the recession isn't a sure thing. Well, was the recession a sure thing? Despite awful headlines and palpable fear, the average diversified stock fund has fallen a manageable 13%. In the past year, job creation is growing faster and inflation is tame. Interest rates are falling fast. Sounds pretty okay, right? Sounds like, the world's going to be all right here. Things are going to be good. But what happened? The S&P declined by more than 40% during that period, 2000 and 2003. So the headlines would kind of lead you to a pretty good time, but the results were pretty awful. Here's Mark Twain's, says it best, I believe. History does not repeat itself, but it does rhyme. So is the world different? Or is it just another little bit different version of what we've seen before? Economies have expansion periods and they have contraction periods. We expand and we contract, just like we have summer and winter. And when we get to winter, we don't all sit down and go, "Oh, I don't like it here. I want it to be summer." We know that it's going to be winter for a certain amount of time, and then it's going to be summer. Well, when we have recessions, that's just it's a learning period. We can actually learn from recessions. We can gain market share in recessions. We can learn how to manage our companies better in recessions. And we can grow in recessions and get ready for the next expansion. But we have to think about it in terms of what are the positive aspects of it, knowing that it's all going to happen. Yes, Gail?
Looking at that retrospect, though, have you ever seen as many layoffs from the 1970s as we've seen right now?
Unemployment has been higher than it is today. Yes.
That's right. In 1980 it was 10%.
Right. Yeah. So every time there's something that happens, I think the combination is kind of like a different puzzle, but it's a little, the pieces all still come together the same. A little different puzzle, a little different set of situations, but we still are having some sort of overzealousness in some form of market that's going to basically now put us in a session for recovery or basically reconfiguring our economy. So what's the bottom line here? There are no guarantees, but throughout history, investors have been rewarded for long-term investing in stocks, staying the course, through the short-term noise. There's always short-term noise. There's always something going on. And the noise is even more than ever. I mean, turn on the radio, turn on the TV. Every time you turn around, somebody's announcing the bad financial news of the day. So sometimes it's just better not to pay attention to the financial news of the day. Because as we can see from Time Magazine, what's happening in the financial news is maybe not what's happening in the economy. So the breaking news is this time is not different. So I would ask this one question. What's the role of media? Greg? Scare the hell out of it. And why do they want to scare the hell out of us? Sell more ads. If we're scared, we're going to buy more. We're going to look for more answers. We're going to pay attention more. We're going to spend more time at the TV. We're going to buy more newspapers. We're going to be more attentive, right? So they're meeting their purpose. I'm not saying they're bad people, but is their purpose aligned with our purpose? It may not be. So, and what's the role of a responsible advisor? I ask ourselves that a few times since October. Certainly to be empathetic. It is not an easy time to be an investor. It is not an easy time to be in business. To coordinate your investment policy with your cash flow needs. I think that's the number one thing. Do you have enough cash? We're going to look at downturns. Do you have enough cash to sustain your lifestyle during the downturn? If you do, then it all is just short-term noise. That's the most important thing. Do you have enough bonds and cash to get you through from where you are now to when the market recovers? To put emotions in their place. Certainly, we don't want to be, it is easy to get very emotional about what's happening, especially with the headlines. But the other thing is we know if we're reacting to emotions, we're going to lose. We have to stay calm and you look at the data and look at the results and make rational decisions. And of course, to listen. I think that's the most important thing that we can do. So if we're not calling you, we hope you'll call us. We want to hear you.